Hi, my name is Jeff DeWeese, and I'm the Chief Investment Officer at Oric Capital Partners. What if I told you one of the fastest growing parts of finance isn't the stock market, isn't crypto, and isn't even the banks? It's something called private credit, a market that's quietly exploded to over $2 trillion. And most investors barely know it exists. Private credit is basically lending money outside the traditional banking system. Instead of a company borrowing from a bank like JP Morgan or Bank of America, it borrows directly from investment firms, private funds, or institutional investors. Think of it as Wall Street becoming the bank. Here's why it works. Traditional banks are heavily regulated. They often move slowly, require lots of approvals, and may avoid riskier loans altogether. Private credit firms can move much faster and customize deals directly with companies. For a business trying to buy another company, expand quickly, or refinance debt, speed and flexibility can matter more than getting the absolute lowest interest rate. After the 2008 financial crisis, regulations made banks much more cautious about lending. That opened the door for giant investment firms like Blackstone, Apollo, and Ares to step in. Now these firms lend billions to companies for acquisitions, expansion, refinancing debt, even funding AI infrastructure. Because the loans are private, the lenders can negotiate almost every detail directly with the borrower. Investors love private credit because the returns can look very attractive, especially when interest rates are high. Many private credit funds promise yields much higher than traditional bonds. That's why pension funds, endowments, insurance companies, and even some retail investors are pouring money into it. And despite the scary headlines, defaults in private credit aren't always as catastrophic as people imagine. Why? Because these loans are often senior secured debt, meaning the lender is first in line to get repaid if a company runs into trouble. Private credit firms also tend to work closely with borrowers long before a collapse happens. Instead of immediately forcing bankruptcy, they often restructure loans, extend timelines, or renegotiate terms to the company to keep the company alive and preserve value. In many cases, they have more control and more flexibility than traditional bondholders. For years, it looked like a win-win. Companies get fast financing, investors get strong income, private lenders collect high interest payments, but there are things to pay attention to. Private credit is far less transparent than public markets. These loans usually don't trade openly, prices aren't updated constantly, and during economic stress, it may be hard to know what the assets are truly worth. Critics worry the market hasn't really been tested by a severe recession yet. The concern isn't necessarily that every default becomes a disaster. The bigger concern is whether investors are underestimating how correlated these risks could become during a downturn, especially if too many companies need refinancing at the same time. In other words, everything looks stable until liquidity disappears. Private credit might become one of the defining financial stories of this decade. It could prove to be a smarter, more flexible replacement for traditional lending, or the next area investors suddenly realize they never fully understood. And that's exactly why it matters. As always, stay calm, stay diversified, and stay positive. From all of us at Oric Capital Partners, we wish you all a great day.